Hey, really, thank you so much for the introduction, and thank you for having me today. And thank you everybody for giving me your time. And I just want to talk a little bit about Rightline and really what I consider our mandate to be is to look at all the independent variables that are present in the financial markets that determine the future movement of price. I'm going to move to the next slide. And I think that there's a problem with current technical analysis. There's a lot of good systems out there, but there are a lot of systems that really do not work. And what they rely on is the same technical analysis and the same indicator analysis that traders have been using for the past 15, 20 years plus that simply have not gotten them to profitability. And obviously, you know, if you want to work with a prop firm, you want to get set up, you want to day trade profitably or swing trade profitably, it's very important that you use software and you use a trading technique that's effective. Now, if you think about the fact that 95% of day traders fail, and that number has not improved over time, you really have to scratch your head in the sense that that would be unacceptable in any other field of endeavor. I mean, if that was in architecture or engineering or in medicine, it would just not be allowed to continue. 95% of all the buildings that were erected collapsed, or 95% of all the patients that were treated in medicine died. What would happen early on is a scientific analysis would be determine which elements of the architectural analysis or what components of medical therapy were not working, and they would be eliminated. And so over time, there would be an evolutionary process. And you'd see that the number of buildings erected would slowly get better and better until there was an acceptable percentage, and until that actual percentage reversed. 95% of buildings erected were successful. 95% of patients traded did well. But for some reason, that evolutionary process does not take place in day trading. And that's because we accept a priori, for some reason, as being true all of the trading techniques and technical analysis that have failed generations of day traders before us. And so what we really have to do is take nothing a priori as being accurate and workable. We have to look for an analysis that validates the concepts mathematically. And if you do a Nexus Lexis search of the world literature, say looking at the statistical analysis of an oscillator or a MACD in getting you into a successful trade, you'll find that there's really nothing. So really, for some reason, scientists have failed to look at day trading and do a statistical analysis on what we use in order to get us into a trade. And what we've done here at Rightline is we've tried to reverse that. And to give you a quick example, I want to show you an oscillator and Renko bars as a quick example. An oscillator is a momentum indicator, and it shows the location of the close relative to the high or low of a given candle. If you're going long, as the close of the candle approaches the high. If you're going short, as the close of the candle approaches the low, the oscillator line is going to move to the downside or it's going to move to the upside. So you need 4 parameters to go into the formula to construct an accurate oscillator line. And that's the open, high, low close of a candle or of a period. Now, what a lot of software does, now in a range bars, that works great. You have a high, a low, and an open and a close. And this gold line, which is the % K line, is actually tracking an accurate oscillator signal. But many software packages add an oscillator with Renko bars. And you'll see with Renko bars, there's simply a high or a low, or you can consider it to be the open and the close. But there's no high, low, open, close. So the oscillator doesn't make any difference whether it's stochastic, relative strength, ADX, ADR, Williams K, does not work on Renko charts. This is the problem with software that we use to swing trade and day trade. And it doesn't matter whether it's the futures market, the Forex market, or the stock market. In addition, traders use the oscillator in two different ways. In the first set of traders, when the oscillator is overbought, they feel that the bulls are firmly in control. So what they do is they continue to buy every broken upside pivot. Eventually the move will peter out and they'll get stopped out, but not after having broken sequential pivots to the upside. The other set of traders, they look to fade the market on oscillator divergence. When price makes a higher high and divergence makes a lower high, they look to fade the market. So now if you have two sets of traders trading the same signals in exactly the opposite way, what does that tell you about the value of the indicator analysis itself in increasing the precision of your trading entries? Well, it told me that it really probably doesn't have much value. So what we did was we looked at 2 years of market replay data, looking at the percentage of successful entries off of each of these strategies. And what we found is that the oscillator doesn't give you any kind of signal with enough accuracy to get you into a trade and bring you to profitability. So what we've done is we've eliminated this indicator completely from our trading platform. This is not an independent force in and of itself that is going to predict the future movement of price. Price drives the oscillator. The oscillator does not drive price. Therefore, we cannot use anything on this indicator to determine where price is going to move into the future. Fibonacci, there's a lot of Fibonacci adherents and Fibonacci proponents. Fibonacci was an 18th century mathematician, and I've read lots of books on Fibonacci analysis, and actually lots of books on Fibonacci itself. And what Fibonacci did was he created Fibonacci extensions, retracements, and his math are Fibonacci transformations. And the Fibonacci transformations gave rise to Fibonacci numbers. And they actually do have applicability to describing certain phenomena in nature. They tell you the number of edges on a snowflake and the number of ridges on a pine cone. But the ability to predict the future movement of price is just not possible. Now, what I'm going to do is I'm going to go into what does predict it, but there's nothing that happens in the past that determines what the future is going to bring for any financial market. The swing low, swing high of the previous pivot is not going to be able to give you, based on a set of Fibonacci extensions, where the market is going to go in terms of support and resistance. I mean, look at the predictive value of a Fibonacci level holding or breaking, and it simply doesn't have the predictive value that it needs in order to make it profitable for you to use them as areas of support or resistance. So we've eliminated Fibonacci. What we're trying to do is get rid of the specific failed trading methodologies that don't predict the future movement of price in any financial market. So, to sum up, what's the predictive value of any indicator that assimilates data from your trading chart only? And what is the predictive value of any indicator that works sometimes but not other times? And the bottom line is the predictive value is so low is that you just can't use this trading analysis. You just can't use these indicators. Now, what you'll find is that any indicator that assimilates data from your trading chart only is simply not going to work. And I'm going to show you what I believe does. Now, just a little bit about trading methodology. You can trade with sensitivity or trade with specificity, or you can make a trade-off on the two. And you have to have a specific goal in mind when you trade, because it all has to be based on math. Now, if you trade with sensitivity, your goal in trading is to try to get every true positive move. So you want to get every winner. If you trade with specificity, you want to avoid every loser. Every time there's a true negative move, which is a move that is not going to make you profitable, you want to avoid it. So what should be your bias? Should you try to get into every winner, or should you try to avoid every loser? And it turns out, if you look at the math, the traders who make money trade with a tremendous degree of specificity. Their goal in trading is not to grab every winner. Their goal is to do the best they can to avoid every loser. So they're going to trade with a very high degree of specificity. Now, ultimately, your win percentage is determined by the sensitivity over specificity times prevalence. Now, the prevalence is in trading. If you translate this math into a trading environment, is when is there going to be the greatest likelihood of getting a winning trade? And the prevalence of a winning trade is going to be highest when you trade a trending market. So if you trade with a great degree of specificity, looking to avoid losers, and you trade during a period where the market is trending, that's where you're going to pull in the greatest degree, the greatest number of winners, and avoid the greatest number of losers. And that should always be in your mind when you day trade or swing trade in any given financial market. Your goal is to avoid risk, and that's what specificity provides you with. You're looking to minimize risk and to avoid taking a loser. And as I said, the prevalence of a winning trade increases in a trending market. Now, I was going to talk a little bit about the laws of thermodynamics, but it's too boring. But it really has to do with why markets chop and why markets trend. The bottom line is that if left to its own designs, every market will just chop. And a market will chop forever. That is based on a closed system and the laws of thermodynamics, which state that every closed system is going to remain in a state of maximum chaos until something is applied. And in the markets, it's the application of money. So when institutional money is brought to bear on any given financial instrument, it takes the chop and changes it into a trend. And that's what we look to track. The bottom line is we want to track the flow of institutional money, because it's the institutional money that is going to predict the future price on any financial instrument. no matter what market you're trading and no matter what time frame you're trading, if you know when the institutional money is flowing into your financial instrument, that is when you want to take a trade. So the independent variables, or the variables that determine the future movement of price, are the multi-time frame analysis of trend. The other is the multi-time frame direction of correlative markets. I'm going to show you how these are directly related to money flow. Also, the multi-time frame analysis of order flow, which is a measure of buy-sell imbalance. Again, a measure of money flow. The multi-time frame analysis of momentum. And then we have to leverage volume, and we do that via the use of market profile. Dependent variables, i.e. variables that are moved by the first five and only confound your trading and make it worse, are oscillators, MACD, Fibonacci, classic Elliott wave. They will not get you into a trade and they will not increase your trading precision. The positive predictive value of getting a successful trading entry will only degrade if you try to take these signals as they assimilate data from your trading chart price. Now, the first is an indicator that does a multi-time frame assessment. The upper line is momentum, and the lower line is order flow. Now, there are lots of ways to assess momentum. And what we do, you can assess it with the MACD, you can assess it with the oscillator. As I said, it's a momentum indicator. We use the Heikin-Ashi formula, and there are Heikin-Ashi bars that we've peeled the formula and smoothed it off the Heikin-Ashi bar, changed it a little bit, and that's how we determine momentum. We determine order flow. I'm going to have to show you a little bit later, but order flow is simply looking at whether there's an excess of buyers on the bid-ask side of the trading dome, or whether there's an excess of sellers on the bid-ask side of the trading dome. If there's an excess of sellers, it tends to push price down. If there's an excess of buyers, it's going to push price up. Now, both of these calculations are not done from any data on your trading chart. This is done from 3 higher time frames. So if you're trading, say, a 5 range, it looks at an 8 range, a 13 range, and a 21 range. If you're trading a 3-minute, it looks at a 9-minute, a 27-minute, and a 54-minute, whatever 27 times 3 is. I can't multiply very well. So this is making an assessment of 3 higher time frames than your trading chart. Now, if momentum is moving down on those 3 higher time frames, price on your trading chart is almost always going to move down. And if order flow shows an excess of sellers on 3 consecutive higher time frames than your trading chart, price is also likely to fall. Now, what we found is these are 2 independent variables, so we want them to align. We want order flow and momentum to project a potential price in the same direction in order to take a trade. Now, when price is red, it means that all the higher time frames align. When the color is orange, it means that only the longer term align. But we always trade in the direction of the longer term time frames. When it's green, all the higher time frames align to the upside. When it's blue, only the longest term time frame aligns to the upside. Best colors are red and green. Now let's take a look at price. Here's your multi-time frame assessment of momentum. The lower is your multi-time frame assessment of order flow. Now, this is an area that I'll talk about later. This is an area of resistance. You can see When price aligns and resistance is broken, price is going to almost always rise on your trading chart. Doesn't matter what you're trading, what your time frame is, whether you're trading stocks, forex, or futures, this price is going to rise because the price on the 3 higher time frames has momentum and order flow aligned to the upside. So this doesn't give you an entry, but it gives you a directional bias, and it tells you that if you try to take a short trade when both of these lines are either green or blue, your likelihood of getting stopped out is exceedingly high. This is the direction you must trade in to get a successful trade. And remember, our goal is to avoid losers. So we are not going to try a counter trend trade. And you can see all the traders in these orange candles, and all they do is get run over as price keeps rising to the upside. Here's another example. Here's order flow and momentum on a multi-time frame basis aligning to the upside, right through here. Now, this is not looking at price on the trading chart here. So price on the trading chart is rising because these two lines are green. It is not, these lines aren't green because price is rising. This is predicting that these two forces are going to bring to bear on price a movement to the upside. And the only time you're going to have the ability to take a trade short is when both of these lines align to the downside, are red or orange. Here's another example. When both of these forces align to the downside on 3 higher time frames, price on your trading chart is going to fall. Now, I put this slide up also to highlight what happens when these two independent variables don't align. Right over here, you have momentum aligned to the downside, and you have order flow aligned to the upside. And when you have that, price chops. And remember, we don't want to trade a choppy market. So when momentum and order flow don't align, you stay out of the market. When they do align, you trade in the direction they guide you. Because these forces, both momentum and order flow, are extremely powerful predictors of the future movement of price on your trading chart. And you only want to take a short trade if you want to take a low risk, high reward trade. Now here's another couple of examples. These are a little squash, and the candles are bigger, but these are trades I actually took live to the short side, to the long side, with the alignment of order flow and momentum. See here in the middle, where they don't align, price chops. And here I want also to use this really to highlight how important it is. Right in this period here, there's no alignment of order flow and momentum. Momentum's the top line, order flow is the bottom. And when there's no alignment, price just chops. When they do align, you wait for the break of this area of resistance, and you're up. But at least you have a defined direction. And in addition, you know exactly when not to trade. And when these two forces don't align, you have to stand aside if you want to minimize risk. Now, the multi-time frame analysis of trend is extremely important. And what this pink background bias means I don't think it was a pun, Deborah, but thank you. When this aligns to the downside, Now we're looking at 2 higher time frames, not 3. And when your 2 higher time frames are moving to the downside, and we define that as our 50, the price has to be below the 50 has to be red and heading down, our 15 has to cross the 50 and red and heading down, and all support to the downside is broken. So this indicator is not looking at price on the trading chart. It's looking at price and market structure on your 2 higher time frames. Trading a range, it's 8 and 13. Trading time, if you're trading a 3-minute, it's 9-minute and 27-minute. Trading a tick, it's 377, and then the next 2 fibs, 610, and the 9-something tick chart. So when you have an alignment like this to the downside on your 2 higher time frames, it turns this background color pink. And this force is almost always going to cause price to fall on your trading chart. So you do not want to take a long trade. So besides order flow and momentum, the alignment of price in a specific direction on the 2 higher time frames in a specific way where the 50 period and 15 period are heading down, price is below them both, and all support to the downside is broken, and you get this pink background, predicts really strongly that price is going to move to the downside. So now, and you can see all the traders in these green candles trying to trade long. And what happens to them is they all get stopped out. And what are they doing? They're looking at Fibonacci. They're looking at oscillator divergence. They're looking at MACD divergence. And they are all getting run over. And here's actual trades. This is when the 50 and the 15 are green. The 15 is crossed the 50 to the upside, and price is above both of those moving averages. Both the 50 period and the 15 period, you get green background bias. And the likelihood of a long trade is extremely high. That's the only safe, low-risk direction to trade. And you can see that this was an 11 3/4 point move and a 14 1/4 point move from entry to maximum excursion. Now we're going to look at correlative markets, and correlative markets are a very, very good way of directly assessing money flow. Now, we know that in the course of a day, different financial instruments go up and go down. Now, why does that happen? Why would the NASDAQ and E-mini go down? It's because the financial institutions have decided that risk is off. They don't want to trade stocks. And there's certain markets that correlate with direction of the E-mini. There's certain markets that correlate with direction of stocks. Every single financial instrument has its correlative markets. And we know, as an example on the E-mini, if the NASDAQ and E-mini fall, notes and bonds are going to rise, and the correlation coefficient is 0.7 or greater. So at least 70% of the time, when the E-mini and the NASDAQ fall, bonds and notes rise. Now, when the NASDAQ and the E-mini fall, certain precious metals rise, certain currencies rise, and what this is simply a rotation of money by the big institutions from asset class to asset class. And that's what we're tracking. We're tracking the big institutional money as they rotate across asset class to asset class. That gives us a great ability to find a trading direction by tracking money flow. Now, this is bonds. Now, we have 6 correlative markets in bonds, 3 in each line. And these lines are called Quanta Lines because the markets are quantitatively weighted by the degree of their correlation. If they correlate 0.9 or 90% of the time, they're more heavily weighted. And you can see when the lines are green, it means that when the lines are ZB, when the lines are green, it means that the markets that rise when bonds rise are rising, and the markets that fall when bonds rise are falling. It's tracking the movement of money out of the inverse correlative markets into bonds and its correlative markets. Now, so when the lines are green, it's telling you the institutions are making an asset class rotation into bonds and the markets that correlate with bonds. And you can see that in this case, we're not even looking at bonds itself. We're looking at only the correlative markets of bonds. And price almost always rises because money is flowing into bonds. Price almost always rises because money is flowing into bonds. And when the lines are green, that's when you want to get into a long bond trade. Now, when the lines are yellow, it means that the institutions have stepped aside. And you can see that bonds just move and chop. Without the application of institutional money, the markets are just gonna move in a haphazard direction, and that's the time you want to stand down. Now, when there's one green quant line, you can still trade, but the risk is much higher. You want to wait for them both to be green. Now, this was the trade I showed you before, where you had the background bias. Now, usually you get a multi-time frame alignment. At the same time, you get an asset class rotation. And on the index equities like the E-mini, the Russell, the Dow, and the NASDAQ, we have 3 lines because we have 9 correlative markets, telling you that money is flowing into the E-mini and its correlative markets and out of its inversely correlative markets. Now risk is on, and the big institutional players want to sink their money into stocks. So they're going to push up the E-mini because these 3 lines are telling you that money is flowing into the E-mini and its correlatives. And this is when you get usually that background bias alignment. We're going to put it all together in a minute. Right now we're looking at each independent force that predicts the future movement of price on its own. And this is it. Now, this is the full platform. You have more than just the lower 2 lines are order flow and momentum. The middle 2 lines I have not discussed yet, and the upper 2 are the lines that I just showed you. And you can see we get a move up, a pullback to support, and a continuation trade on the NASDAQ for 31 ticks. We made $280 on that trade. This was a trade on the NQ as well. Now, we only had 2 correlative markets. We also had order flow and momentum, and this middle indicator, which I haven't discussed yet, enough to take a long trade on a pullback to support and a move up for 21 ticks. It made $240. Now, I want to talk a bit about volume. It's very important to leverage volume in your trading. And we use market profile. It's a very different kind of market profile, but it's really based on fundamental math. This is the normal distribution of any set of data. It creates this perfect distribution around the mean in which the mean, the median, and the mode are the same, and 1 standard deviation's worth of data is symmetrically placed above and below the mean price. That's in a perfect world. Now, in an imperfect world, this is our market profile. The market profile is extremely important because volume in a live market from second to second is providing you with areas that price does not want to go. If it hits these prices, it's likely to bounce. Now, that one standard deviation's worth of volume at price creates fair market value. That's the value that traders have decided they want to keep price within. And it's bounded by the value area high and the value area low. And the VAH and VAL are going to work very hard to keep price inside it. And that's been predetermined by volume at price in an auction style market by all the previous volume that's crossed on the financial instrument. Now, the point of control is the price that is most commonly traded for any given financial instrument. It's got the most volume at price. This is where traders want price to be. So when price heads up to the value area high, it's going to be pushed down. When price heads down to the value area low, it's going to get pushed up, and it's going to be attracted to the point of control. Now, in addition, they're critical low volume nodes. Now, this is a lot of information, but this is all very important and relevant to trading. A low volume node is a price that traders just don't want to trade that financial instrument at. They don't like this price, 23. They don't like 12, 40, there's no volume at this price. So these are also going to reject price for different reasons than the value area high and value area low, but you've got these two confluent lines, both of which want to reject price strongly. When you look at this chart on a live market, you're going to see how tough it is for price to cross these areas. So what we do in the software is we create what's called zones of rejection. And the rejection zone is created by the value area high and this low volume node, and the value area low and this low volume node. Now, there's two things about our market profile that are critical. The one is they calculate all of these parameters intra-candle. Now, if you're trading a 3-minute or a 9-minute or a 4-hour or a 2-hour, you cannot wait for the candle to close to get an accurate assessment of where the value area high, value area low, point of control, where these zones are. You need to know intra-candle. Our profile adjusts every time a contract or a lot or a share of stock is crossed, and the volume profile contour it's changed enough to change market profile. So you know from second to second exactly where it is. The other is, just like we do a look forward period for almost all of our indicators, we do a look back period here and accrue a proprietary amount of volume from the previous days to give the value area high, low, and point of control and these rejection zones real throw weight. I mean, these are based on a multi-day assessment of where price simply does not want to go, and they hold up really strong as areas of support and resistance. And if you look right here, price hits, bounces, hits, and bounces, will not move through. Price comes through and it does break support. And you wait for the price to come back to hit resistance, and you take your short trade. But you can't trade into this because you can never predict when this is going to break or whether it's going to hold. And very often, it's going to hold. So when you can't tell what's going to happen out into the future, you have to stand aside. Now, there are 3 system-generated entries. Now these are smart entries. The first is a strategy entry, we call it. And this is a software generated entry, and they've been doing wonderful. We still have to make an assessment and kind of give it the go ahead before we take it. And we do have an auto trader that takes these automatically. But this is a multi-time frame assessment software generated entry. It evaluates price action and market structure on a multi-time frame basis. So when you see this signal, which is going to occur intra-candle, you simply set your sell one tick below the close of this candle, and you've got yourself a great short trade. And remember, this is doing a multi-time frame assessment, not a one-time frame assessment. And here's two more. This is a short trade, and this is a long trade. And they're set up to only give you these signals at really opportune times. And one of the trades that I took today that I made nice money on was this entry. I confirmed it, and I took it. The others are ABC entry. Now, it's a little bit of modified Elliott wave, and I don't really believe in Elliott wave, but I do believe in trading price action and market structure. I think that's extremely important. Anytime two candles of the same color in continuity occur, according to price action dogma, you have a trend. And the software will put an A after any two orange candles or any two greens. And the A will continue to stay. And then it's going to print a B on the first counter trend candle. Now, I elect to color that counter trend candle magenta. And when the B gives me this counter trend candle, I get an audible alert. And that tells me I have the potential for an engulfing C to the downside. So I get a blinking C here. And I'm going to place my order one tick below the close of the candle and wait for the C to complete. Now, if it doesn't complete, then the ABC pattern disappears, because if it didn't complete, it never occurred. This is just telling you have the possibility for an ABC. If the ABC occurs and fails, you'll see it on the chart. But if the C doesn't engulf the B, this ABC pattern will vanish. Now, what makes the entry so powerful is it's propelled down by two forces. One, you're taking the direction in the direction of the trend. So you're taking the trade in the direction of institutional money. Secondly, you get to be pushed down by the fact that all the traders caught in this long counter trend candle are going to get stopped out. And as they get stopped out, they have to sell their contracts, and they're going to push this trade further and further to the downside. Here's another ABC pattern. A, B, C. It's a very, very powerful pattern. The modified Elliott wave component is the A to B is wave 1, the B to C is wave 2, and the C down is wave 3. And wave 3 is the big wave. That's the wave we want to catch, because that's the big one. That's the only component of Elliott wave that I believe in, but that's really the genesis of the ABC indicator. And it gives us some great entries. Here's two more. ABC and up for 35, the A, the B, the C, and down for 36. And you see we got an ABC here, but this is not a tradable setup. We have to confirm the fact that the ABC does in fact move in the direction of the trend, and it sets up perfectly. And the other one is our consolidation signal. This is all, now the ABC doesn't do a multi-time frame analysis. It's just an assessment of price action and market structure on your trading chart. That is why sometimes you'll get a C candle that just doesn't work, and you're just going to stand aside on it. But the consolidation, like the strategy, is a multi-time frame assessment of price action and market structure. And consolidation is a tremendously powerful pattern to trade out of. Now, what happens during consolidation is that volatility falls, and the power of the bulls and the power of the bears becomes equal. So you have a green candle and a doji, you have a down candle, you have an up candle, you have a down candle. Now the question is when is consolidation going to break, and in what direction is it going to break out? It's almost always going to break out in the direction of the trend. The question is, when is it going to break out? And the higher time frame analysis almost always gives you that answer. So these triangles form intra-candle based on their higher time frame analysis. And if you took either one, if you took the first one, you catch some heat on the trade, but you definitely wouldn't stop out. If you took the second one, it would be safer, and you don't know what's going to occur. So either entry would have gotten you this nice move up. And these are breaks out of consolidation. And this is a software assessment of this low volatility period, trapping at least 4 candles in a row. And here's another consolidation signal for a tremendous move to the upside. Now, the reason that makes these so explosive is the C candle traps one counter trend candle. Consolidation traps multiple counter trend candles. But the definition that we set in the algorithm of the counter trend signal is it has to catch at least 2 counter trend candles or it won't fire. So when it does fire, you're going to run over a lot of traders. And when you run those traders over, they're going to help push this trade to the upside. Here's 2 more out of consolidation, 40 ticks to the upside, and 10 ticks to the downside. And this is a consolidation signal we can't take. It went right into resistance, and it did not work. So we do have to make an assessment. Even a multi-time frame analysis software generated signal sometimes doesn't give us a perfect one. But when they come and they're perfect, we're right on them. Here's another trade. Now I'm gonna try to put some of this together for you. Now here, background bias is pink. We're looking for a pullback to resistance, a continuation. On crude, there's only one correlative line, one quant line, 3 correlative markets in the direction of order flow or momentum and order flow. 44 ticks on a pullback to resistance and a continuation down. The 2 higher time frames are heading down. 3 higher time frames are assessing momentum and order flow to take us to the downside, and we're down for 44 ticks. These are very low risk trades because we're trading in the direction of institutional money that is manifesting itself in the multi-time frame alignment of momentum, in the multi-time frame alignment of order flow, and the quantitative markets, the correlative markets showing you the direction of money flow. That money is being rotated out of crude oil. Whoops. Here's another one. This is 3 1/4 points down on the E-mini. Again, all 3 of our quant lines, the correlative market's red, money is flowing out of the E-mini. Momentum is down, and order flow shows an overabundance of sellers on our 2 higher time frames. Now it's 3 higher time frames, and we go down for 3.25 points. When we get this alignment, it honestly, it's a money-making alignment. Now, this is these are just riskier trades. I got 3 trades and 3 winners were done for the day. A couple I took with a lot more risk, but on this trade, I always took the trades in the direction of order flow and momentum. That's a must for me. The correlative markets, here I had 3, here I had 3, here I had none. So this was a much riskier entry. And I wanted to show you that your trading is discretionary, but you've got to trade in the direction of the multi-time frame assessment of order flow and momentum. Here's a move up, correlative markets, background bias, 3.75 points. Here's down for 19 ticks. If you know the direction of institutional money flow, and you're trading in the direction, the multi-time frame alignment, and you take a trade right off resistance on a pullback into resistance to the downside, you've got yourself a very low risk, high reward trade. Now, today on the NASDAQ, it very rarely aligned. We trade a 13 range NQ, and I only got 1 NASDAQ trade. It made $160, and I only got 1 E-mini trade in the live trading room, and it made $75. Yesterday, I had a trade on the NASDAQ for $320 and for $295, and we finished with 2 trades in a half an hour. We made $620. When we get this alignment, it's really all depends on what the market gives us. Today didn't give us much, so I was only able to get 1 NASDAQ, which was a double, and 1 E-mini, which was a single. Yesterday, I had 2 home runs on the NQ. Here's the trade, the same again. Always in the direction of the correlative markets. This is a different kind of, I want to go over all the meaning of all the different colors. This is a strong alignment of price on our 2 higher time frames to the side, giving us a really nice trade for 3.75 points. Here's a trade to the downside right here. 34 ticks, made $360. Entry is right here in the direction of money flow and the multi-time frame assessment of direction. Another one, 34 ticks. The retracement back to resistance, always in the direction of the multi-time frame alignment of trend, and always in the direction of institutional money. Here's 2 more. These were bond trades. Now, I don't trade the bond market. We have an auto trader that does that. The auto trader had a 281.75 for 7 and a 218.75 for 5. Taking signals off of order flow, momentum, and the quant lines. Now, it'll allow 1 quant line to be yellow as long as order flow and momentum are both red. That's the algorithm for our auto trader. Now, we trade off of this. We don't trade directly off the dome. Let me see. No, Matt, it does not make any difference what the volatility is. Listen, you're going to make an assessment. You're going to look at volume profile. I don't think I have enough time to bring up the platform. I wish I did. But we have a couple of really unique volume indicators that are going to tell you. Let me show you right here. You see this indicator? This is a volume indicator, and this is called a volume hammer. And the reason it's unique is because all the other indicators who look at volume look at the amount of volume accumulating under a given candle. And that gives you, what, in my opinion, an inappropriate assessment of volume. Now, let's say, because there are two independent variables that go into that assessment. One is how many contracts, how many shares, or how many lots are crossing per unit time, and also what is the rapidity, how many candles are forming per unit time. I mean, let's say during this candle, the power of the bulls and the power of the bears is equal for a significant period of time, and it just sits there, and it accumulates volume, and you see this big volume spike in the histogram. Does that actually mean that this was a high volume candle, or that the rate of candle formation at that point was extremely slow? So what we did is we teased it out, and our volume hammer looks at volume per unit time. I have this set, so what this does is it traces out how much volume is crossing per minute on a live basis. So the right edge of this counter is telling me how much volume is actually crossing the market at a given time. So you can determine, you have to know your financial instrument. You're trading the E-mini, you want to see 1,000 contracts crossing a minute. If you're trading crude, you want to see 300 to 400 crossing a minute. If you're trading the NASDAQ, you'd like to see 800 to 1,000 contracts crossing a minute. And by knowing that, the volume hammer is going to give you the exact data that you need. It's going to tell you how many contracts are crossing, whether volume is strong enough to give you a reliable signal to trade at that given second. So I think that you're asking the right question, and that is, do we have strong volume on the market? And today I had 2 trades and 2 winners, and I wanted to get a third, but volume died. I mean, the E-mini died, volume on the NASDAQ died, so we quit. We're not going to trade a low volume market. And usually low volume is equatable to low volatility. Now, this is how we trade. We do not trade. We're active on NinjaTrader. We'll be active on Sierra in a very short period of time, in less than a week. We use our own Amit. It depends on what market. Amit asks, how much volume should you be trading, should you look for in order to trade? Well, it all depends on what your market is, Amit. If you're trading a stock, I mean, you want to, you may want to see 50,000 shares crossing. If you're trading a Forex market, it's going to be different. If you're trading a futures market, you're going to, like I said, if it's the E-mini, okay, stocks, I mean, listen, it totally depends on the stock you're trading. Like I said, every time you get a financial instrument you want to trade, you have to get a little bit familiar with it. I mean, let's say, listen, if you're trading off Facebook, that trades 50 million shares a day, you're going to have to get somewhat familiar as to how many shares are crossing at any given minute between 9:30 and say 10:30 or 11 o'clock. I mean, that's what I do in all the markets I trade. Since I haven't really traded Facebook in about 6 months, I can't really give you a perfect number, but you have to get somewhat familiar with every instrument you're trading, because you're going to get different volume. If you trade a small biotech, the volume you look for may be appreciably lower. I mean, when we were trading stocks, I just ran out of energy. I traded the Forex at 4 o'clock in the morning. I traded the futures market starting at 8:30 in the morning, and then I traded stocks in the afternoon, and I just got exhausted. And I used to trade Facebook, Netflix, Apple Computer. I like to trade Delta Airlines. I like Bank of America, all high volume instruments, and then I would always put in a small biotech that I would assess from the morning that was either upgraded or downgraded, in which we're going to get good movement and good volatility and higher volume. But I always got familiar with what I was trading and got a good idea of how many shares I want to see crossing per minute in order to come to that conclusion. And you have to do that on an instrument by instrument basis. No, there's no percentage. It's got to be an absolute number. I mean, you know, if you look in Yahoo, it's going to tell you the average number of shares crossed in a given day, and then you're going to have to do an assessment of how many shares. Remember, if we go back here, the volume hammer is going to do all that for you. When the volume hammer, I'm trying to scroll over, is way up here, you're going to know that a lot of shares are crossing. And remember, because it's doing a minute-by-minute calculation, when it starts to drop and starts to bump along the bottom here, you already know that the assessment of this volume hammer is telling you that now you're trading on lower volume. So this is going to do it for you. And all you have to do is watch your trading instrument for a few days and get a feel, and then you're set to go. It's not a percentage. I'm sure it is a percentage, but you're better off looking at the absolute number. It's going to give you a much better feel, and the volume hammer is going to tell you exactly what you're doing and where you are. This was a volume spike at this particular minute in trading. It had nothing to do with the rate of candle formation. Now, this is our trade execution platform, and we've had a patent pending for 2.5 years. We have a patent number, and it's in the patent office, and one of my partners and I paid a lot of money to an attorney to have this thing patented. And this is how we take all our trades. We don't trade off of any other platform. We don't trade intra-candle, because I don't believe that that's a great idea. I think that the market is expressing itself. And I don't want to run overtime. I'm not sure what my time is. I started at 3:15. I don't want to run too far. I'm almost done. I don't like to trade intra-candle. I think that every candle, the market is telling you something. Because I do believe at candlestick formations are a manner of market expression in terms of the strength of buyers and sellers. So if I want to take a long trade, I just press buy on an up close. That it's going to automatically give me an entry one tick above the close of the candle. And if you're trading minutes or if you're trading ticks, you don't have to chase that price on the dome. It's automatically going to execute, I mean, with rapid speed, so you're rarely going to get slippage. If you want to take a short trade, you just hit sell on a down close, and it's going to give you an entry one tick below the close of the candle. And if you're trading time or tick, you don't know exactly what price the candle is going to close at. But if you're ready to take a trade on the close of the candle to the downside or to the upside, just that button is going to get you that price almost always. Now, if the market's moving like fire during an announcement, you may get a tick or two of slippage, but it's always going to do better than you can do manually chasing the price on the dome. And we take our exits off of this, because if we take a short trade, we're going to close on a reversal candle, which is close on an up close. If we take a long trade and we get a short reversal candle, we're going to close on a down close. That limits our losses on every trade and minimizes our risk. So first, if our first target is 5 ticks and it goes 3 and comes back, our loss on a reversal candle is going to be significantly lower than it would be if it went all the way back to our stop. This really helps us trade. This is part of the software that we give out. It's the same thing is true for stocks. If you want to buy an up close or sell a down close, it's going to get you in with incredible precision on the up close or the down close. And I traded stocks for a long time. I haven't in a while. just because we have so many traders in the room who in our trading room right now who want to trade futures. And yesterday we made $620, and today we made 350 and change, just because they're 250, just because the trades weren't there today. But we shoot on a small number of contracts for $1,000 a week for a $52,000 a year on a tiny amount of contracts. So this is what we're looking at. The bias indicator does the multi-time frame assessment of price. That's the background color. The correlative markets, futures, and cash markets. And if you trade stocks, our correlative markets are incredibly good. I mean, I don't want to. I mean, I'm going to toot my horn for a second. We use 21 separate ticker symbols that look at market internals on these markets. And they include the multi-time frame assessment of upticking versus downticking stocks. We look at up volume versus down volume. We look at ETFs that highly correlate in the direction of your overall market. So you have to put the ticker symbol into the indicator, as well as the fact whether it's the NASDAQ or the New York Stock Exchange or the S&P 500. We would tell you what to put in, and we have 21 different metrics that are evaluated for the correlative markets on stocks. They are superlative assessments of the future direction of price. And on the futures cash markets, we have 3 lines. And when all 3 of those lines are green or red, I tell you, your trading instrument is very likely going to move to the long or short side. We do the multi-time frame assessment of order flow, multi-time frame assessment of momentum. We leverage volume. We have our entry signal, strategy, momentum, and C candle. Then we have the NDT trade execution platform. And our goal is really to combine what we believe are all the independent variables that are responsible for the future movement of price. They predict where price is going to move in the future. We can hone down on an entry and trade in that direction and get a low-risk, high-reward trade. Not every trade is going to work, and if anybody tells you that, obviously they're not telling you the truth. But if 80+% of your trading entries taken conservatively work, you're going to make really good money. I left out optimize, but that's what we do. We believe that these independent variables are responsible for the future movement of price. And when you optimize a multivariable equation, your work is never done. Because when it's perfectly optimized, you're going to predict the movement of price 100% of the time. And obviously, we can't do that, and nobody can. But that's what we work towards. And we always look for additional independent variables to help us determine future price direction. But we never stop, and we never stall, or we never stand on what we've done, because we always believe that we can move into the future and make our software better. And if we do get a better indicator, and we have done a million upgrades, you always get that automatically if you own the software. We never charge it for add-ons and upgrades. And we've upgraded our market profile on our correlative markets, our Quanta Lines many times. So here's the offer. We give you the NDT trade execution platform, which I mentioned to you. And that is the tool we use to get into our trades. Now, a lifetime license on the website is $1,500. And you're going to get into your trades with less slippage and greater precision. We have a lot of people who just lease it on a monthly basis because it will save you money on every trade. I don't want to say every trade. It's going to save you money on most trades. You get 3 months in the live trading room. You're going to trade with me. Now, even if you trade stocks, I trade futures. If you want to learn a really comfortable way to use the software, you want to learn how I leverage each individual indicator, and you want to become comfortable with it, then it's really nice to sit in while somebody trades the market live using the indicator system. Like, I don't sell it to you or proffer it to you and then go hide in a rock. I am there every morning at 9:15, and I trade until I leave. And almost every day, I would say 9 out of 10 days, we make money. So it's very helpful to see the system live and in action. Then when you get really proficient, you can break off on your own if you want to trade stocks or you want to trade Forex. We also give you 12 weeks of our trading school. Now today we had lesson 6, and we throw that in. And I'm going to teach you how to trade appropriately. I'm going to teach you our methodology live, and I'm going to teach it from the ground up. I'm going to teach you a lot of stuff that you're going to have to unlearn. I'm going to teach you the things that I believe are going to make you a professional, profitable trader. And they make an enormous number of our traders profitable. Now, it's not 12 weeks, it's 10. And we just did lesson 6, but you'd get 1 through 5 on a link, and you'd be in for 7, 8, 9, and 10 live in the trading room. We do that at 1 o'clock, and we did it today. And it's very, very helpful. I'm telling you, it's soup to nuts. If you're a new trader or an advanced trader, it goes all the way through. And I'll tell you something that it teaches you how to build. And I'll get to the question in a second. How many people know how to build an automated trade management strategy? Let's say we have Amit in the room and he's trading a stock. And let's say he wants to trade Alibaba. And he wants to take an entry, and he wants to know, well, what's the stop? What's my first target? What's my second target? And what's my third target? How can I optimize my profit on the trade? What's the minimum stop I can set? And what are the best targets for me to set to scale out of the trade? How many people know how to build that? Now, you always hear people in tutorials say, you know, if I risk $1, I want to make 3. Well, it's all well and good what you want. That's a far cry, though, from what the market is going to give you. So what we do based on the amount of risk you want to take is we have a mathematical model, and it's based on the average true range or the volatility of your trading instrument. If you're trading a very volatile instrument like Google, although Google's very expensive, but if you're trading a volatile instrument, say like Apple Computer, which is, you know, any of these tech stocks, we look at its volatility going back 2 years, and from that 2-year volatility assessment, we use the ATR, the average true range. We can set up an optimal ATR for you, or ATM, an automated trade management strategy, to give you the smallest stop so that you don't get wiggled out of the trade on simply background noise, and you have the best opportunity you can to take out all your targets after your entry. And we also will show you how to set a trailing stop. If you set it too tight, you strangle the trade. And if you set it too far, you're going to lose too much if the trade peters out and comes back and takes you out before you get your 3 targets. That's a mathematical assessment. It's not based on what you want. It's based upon the volatility of your trading instrument. And our 9th module is simply setting up a trade management strategy and not simply saying, well, you know, if I risk $1, I want to make 3. Well, we'll tell you if you can make 3. The market will tell you if you can make 3. Your trading instrument will tell you if you can make 3. The math will tell you if you can make 3. We'll also give you lots of templates for over a dozen different markets. So if you want to trade different stocks, we'll create the templates for you, and we'll show you how to make the templates, because the inputs on the templates, they're not complex, but you have to get familiar with them. Because remember, the indicators do multi-time frame assessments, and the inputs ask you for what that multi-time frame is. A lot of them do it automatically. But we'll set up a dozen for you, and we'll teach you how to set your own templates. And now the full indicator suite is $27.50. Now what we're going to give you, I didn't realize we were going to do this on this one, but we're going to give you the automated and the non-automated system. We're going to give you both. Now the automated, I didn't even know that was part of this. I swear, or I would have talked about the automated system. The automated system trades 7 markets. It trades gold, crude, bonds, notes, the E-mini, the 6E, and crude oil, automatically. Today it had a winner on bonds. I don't trade bonds. Normally they're $27.50 each. And the total value really is $92.46. And with the webinar special, you'll get the discretionary system, the system that we trade, also the automated that you can set up on 7 futures markets. And it's either $27.50 or 2 payments of $1,500. It's only the first 5 orders can get the automated and non-automated together. If you are not one of the first 5, you're going to get the non-automated along with the specials, but you won't get both. And this expires on Friday. So let me see, and let me just finish up the questions. And the automated system is really good. It's really is a separate set of, it's a separate revenue. And if you go to our website, you can see, let me see if I have the time, if I can get to it. I can't do it because this is blocking it, but we have both our trading room profit and our automated trader profit. It's just too tough for me to do. Data fees, Michael. Okay, is there a specific trading platform? Michael, okay, is there a specific trading platform? We're on NinjaTrader, Michael, and we will be on Sierra. You can download a demo for free, and we provide you with a 1-month free data feed. And after that, I think it's really cheap for a data feed. I think it's like $7 a month. So it's very, very inexpensive. So there are data fees, but the first month we can get you a free data feed because we have a relationship with Ninja, and we can hook that up for you, and you won't have to pay anything for the data feed. No, Matt. If you use NinjaTrader, you can trade stocks. What you have to do is you have to pay an additional $54 a month, $55 a month, which I do, and get a kinetic data feed. In addition, look, the free data feed that we can get you for a month, and then the $7 a month thereafter, is for futures. FXCM is the Forex data feed. If you want to trade stocks, you have to get the a kinetic data feed, and that will cost you, the basic is $55 a month. And I think that gets you 500 tickers. Yes, no, it works great through Kinetic. Every morning when I open my platform, I automatically connect to CQG, Continuum, and Kinetic. I have all those data feeds connected at the same time. Because I didn't want to get into it because it's a little complicated. I only have 2 minutes. But we actually use data from the cash markets to trade the futures markets. It's an experiment, and it's working out incredibly well. But because it's a very complicated setup, it's a very complicated concept, but we pull cash data and project it onto the futures markets. I didn't even talk about the indicator because I didn't want to confuse people, but I'll just show it to you real quickly. So we need a kinetic data feed. I pay for the kinetic data feed. Let me see if I can find it. And I'll just share. I don't want to confuse anyone. And I really wanted to show you what we're about. But we have found this to be another independent variable after being snooping around a long time. And I know I put it on one chart. Hang on 1 second and I'll find it. Where did I put it? Maybe I didn't put it on any, but there's 2 more lines that we have. Let me find it. I know it's on one slide. Hang on a second. I can't find it, I'm sorry. But we actually look at cash data to help us determine the direction of the futures markets. There's a significant correlation between the direction of the E-mini S&P futures market and the E-mini S&P cash market. And we carry that data into our futures platform on the kinetic data feed. It's really quite amazing. And that's how we've harnessed the NQ. The NQ is incredibly volatile, and it moves like a rocket ship. But with the cache data coming off the kinetic feed, we've got it tamed. So the full suite is for futures, forex, and stocks. We will format it for you for all 3. That's a lot of work. And the forex market is a completely different set of indicators because they're specially formatted to trade forex. But you get those as well, and they're all FX indicators. But it's the exact same system, exact. I didn't give you my forex talk, but you get great forex trades. I just wish I could get up at 2 a.m. I'm a single dad. I can't do it. And the automated system is only geared to trade. I want to be very clear. Is only geared to trade the futures market. And it's only set up, automated on our algorithmic system to trade those 7 futures markets. It will not trade the forex, and it will not trade stocks, but you can trade all 3 on your own, and we will format them all for you. Dashboard included, Manish. You know about the dashboard. I didn't go into that. Yes, John, and if you call us up, I'll go over that with you. Yes, but we will include the dashboard, Manish. Now, the dashboard's our trade analyzer, and if you want to trade 100 stocks, our dashboard will give you the signal to open the stock and take the trade. It looks at all the independent variables I told you and places them on a strip. And the strip is our trade analyzer. And when you get an audible visual beep, it means open the stock, take a look at where you are. You're very likely to have a perfect setup, which you will be able to take by just pressing that NDT and buying the up close or selling the down close. So listen, that's it. I don't want to overstay my welcome, and I really appreciate everybody at MarketFest for having me and for everyone in the trading room. Let me just give you our, we're rightlinetrading.com, info@rightlinetrading.com, and our number's 855-765-6681. Thank you so much for having me. I really, really appreciate it. And thank you, everybody in the room. Thank you so much.